Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the big confusing world of corporate finance by decoding their filings. Today, we're diving deep into MasterCraft Boat Holdings' latest 10K report for the year ended June 30, 2025. Will they be sailing smoothly or are there storms ahead? First off, like most companies, they start with a big disclaimer about forward-looking statements, basically saying, look what we're saying now might change and it's not a promise. They're essentially managing expectations from the get-go. Now let's get to the heart of it, the numbers. In fiscal 2025, MasterCraft saw its net sales drop to $284.2 million, down from $322.4 million in 2024. That's a significant drop of about 11.8%. Think of it like losing about 1 in every 9 customers, pretty substantial. This decrease was mainly because they planned to sell fewer boats to help dealers manage their inventory. This is usually a smart move to avoid having too many unsold boats sitting around, but it directly impacts their sales figures in the short term. Looking at their segments, the MasterCraft brand specifically saw sales decrease by 8.4%, falling to $24.8 million from $262.7 million a year earlier. This means even their iconic brand is feeling the pinch. The pontoon segment, which includes their Crest and Ballast brands, took a much bigger hit. Sales here plunged 27.1% down to $43.4 million from $59.6 million. This is a massive drop and suggests the pontoon market might be even tougher, or that this part of their business is struggling more. Across the board, total unit sales volume dropped a sharp 23.5%. That means they sold over a fifth fewer boats compared to the previous year. This aligns with the sales figures, but really highlights a slowdown in demand or a conscious effort to cut back production. Scroll across Prostitutes now onto profitability. Their gross profit fell from $71.6 million in 2024 to just $56.9 million in 2025. This is a 20.6% decrease. What this means in real terms is they're making quite a bit less money on each boat they sell. Their gross margin percentage also squeezed down from 22.2% to 25%. This is a 20 point a bit less money on each boat they sell. Their gross margin percentage also squeezed down from 20.2% to 20%. That means for every dollar of sales, they're now keeping about 2 cents less. It might not sound like much, but on millions of dollars, that adds up significantly. The report blames this on lower cost absorption because they weren't producing as many boats, plus rising material and overhead costs. Scroll curating income scrolls here. This drop in sales and margins directly impacted their operating income. It plummeted from $27.5 million in 2024 to just $11.2 million in 2025, a massive 59.1% decrease. Basically, their core business operations are bringing in a lot less money than before. Scrum income from continuing operations for austere and the bottom line income from continuing operations saw a similar drastic fall. It dropped from $23.2 million in 2025. That's a 53.9% decline. This shows the challenges the company faced throughout the fiscal year. Scroll senior leadership transition and organizational realignment cost roles. Interestingly, the report mentions senior leadership transition and organizational realignment costs. These amounted to $1.7 million in 2009 Tasman dollars. In 2009 to $1.7 million in 2009 FICE. These are the one-time costs associated with changes in leadership like executive departures or restructuring efforts. While these are a drag on profits in the short term, they're often necessary for a company's long-term health. Scroll MasterCraft segment specifically, their operating income dropped by a massive 30.1%. Even though their sales only dipped 8.4%, their profitability took a much bigger hit. This higher percentage drop in profit compared to sales suggests that costs within the MasterCraft brand segment are rising faster than their revenue, or that they're having to offer more incentives to move their premium products. Scroll Pontoon Scroll Thiv, the pontoon segment, is in even rougher waters. They went from an operating income of $2.1 million in 2024 to an operating loss of $9.4 million in 2025. That's a 349.5% swing into the negative. This is the most concerning part of the financial picture, a direct indicator that this segment is not only losing money on sales, but its costs are exceeding what it brings in. Scroll senior leadership transition and organizational realignment costs roll. You know what's super interesting here is that the pontoon segment's operating loss of $9.4 million in 2025 is significantly higher than the $1.7 million in senior leadership transition and organizational realignment costs they reported. This means that even without those one-time costs, the pontoon business was already struggling substantially. Scroll net cash provided by operating activities role. Let's shift to cash flow. The company generated $38.2 million in cash from operations in 2025. That's a big jump from just $12.2 million in 2024. This improvement in cash generation is positive and suggests they've gotten better at managing their working capital like inventory and accounts receivable, maybe by collecting payments faster or reducing their inventory levels. Scroll stretches as a property, plant and equipment roster. They also spent $9.2 million on property, plant and equipment or capital expenditures in 2024. This indicates they're not aggressively expanding their physical assets right now, likely focusing on efficiency and managing existing operations through uncertain times. Kroll principal payments on long-term debt or financing activities show a major change. They used $49.5 million to repay outstanding borrowings of the term loan in 2025, completely paying it off. This significantly reduced their debt load, which is generally a good sign for financial health. Scroll stacks the Soster now. Let's look at the risks. They have a whole section dedicated to what could go wrong. Under risks relating to economic and market conditions, they highlight the impact of inflation and elevated interest rates, potentially discouraging consumers from buying expensive items like boats. With interest rates being higher, it makes financing a boat purchase more costly, so people might hold off or buy something cheaper. This is a classic recessionary risk. Scroll our variable rate indebtedness subjects us to interest rate risk Scroll. They specifically mention variable rate debt, meaning if interest rates go up, their loan payments go up too, which would eat into their profits and cash flow. Scroll depend on our network of independent dealer Scroll. A huge operational risk they face is their dependence on dealers. If dealers aren't selling well, or if they have financial problems, it directly impacts MasterCraft. They even mentioned Tommy's Boats declaring bankruptcy in the past year as an example of how dealer issues can ripple through the market. Scroll, our ability to remain competitive depends on successfully introducing new or redesigned products and services that meet consumer expectations, keep coming up with exciting new boat models that people want to buy. They risk falling behind competitors. This competitive pressure is constant in manufacturing businesses. Scroll impairment in the carrying value of goodwill, trade names and other long-lived assets could negatively affect our consolidated results of operations and net worth rolled SIV. They also have a significant risk related to asset impairment. This means if the value of their brands or other assets drop significantly, they might have to write down their value on the books, which would hit their reported earnings. Particularly concerning is their mention of goodwill and trade names being around $54.55 million, representing about 21% of their total assets. A substantial impairment here could be a big blow. Scroll, our ability to remain competitive depends on successfully introducing new or redesigned products and services that meet consumer expectations. Really hammer home the importance of new products. They mention redesigning their flagship X-Star and launching new brands. Success here is critical for growth. Scroll amortization expense related to other intangible assets, niche or Clissy. Looking at the notes to financial statements, we see some important details. For intangible assets like dealer networks and trade names, they had about $31.9 million on the books in 2020-25 after amortization. This is a substantial intangible value tied to their brands and customer relationships. Scroll financing shared public avaskening firmschroll. Their auditor Deloitte and Tu Chi has highlighted two key areas they spent extra time on: product warranties and other intangible assets. Specifically the Crest impairment evaluation. This tells us that these are complex areas for the company where management's estimates require significant judgment, and that auditors needed to do extra work to verify them. For warranties, they are looking at how management estimates future claims and costs per claim for product defects. For intangible assets, especially the Crest brand, they are scrutinizing the assumptions management uses for future revenue growth and discount rates, key inputs for valuing brands and customer relationships. Scroll net income Scroll Fizz overall MasterCraft is in a tough spot. Their net income fell significantly in fiscal 2025 to $7 million in 2024. While they did have some positive cash flow from operations and reduced debt, this was largely driven by cost cutting and lower production. The pontoon segment showing an operating loss is a major red flag. Scroll report of independent registered public accounting firm Scroll. Deloitte says the financial statements present fairly in all material respects. That's the standard opinion. They also confirmed that the company's internal controls over financial reporting were effective. Scrollnet sells Scroll Sue, so what's the big picture here? MasterCraft is navigating a challenging market. They are making strategic moves like reducing inventory and selling off brands like Aviara to streamline operations. The drop in sales and profits is concerning, but perhaps a necessary correction to realign with current market demand. The pontoon segment's profitability issues are a key challenge they need to address urgently. The company's reliance on dealer networks and the constant need for product innovation are inherent risks in this industry. They've managed to improve their cash flow from operations and significantly reduce their debt, which are two big wins. My take is that MasterCraft is in a transitional phase. They are making some tough but potentially smart decisions to improve their long-term health. The market for recreational boats is cyclical and sensitive to economic conditions. The company appears to be focused on its core MasterCraft brand while trying to fix or reevaluate its pontoon business. Investors will be watching closely to see if their cost management and product development strategies can drive growth and profitability in the coming years, especially in the competitive pontoon market. Alright, that's our look at MasterCraft Boat Holdings' latest filing. What do you think about these numbers and their strategy? Let us know in the comments. If you found this breakdown helpful, please hit that like button and subscribe for more corporate deep dives. Also, don't forget to join our Discord community linked in the description for more discussions and exclusive content. Thanks for watching, and we'll see you next time on Corporate Decoves.